Hello, everyone. My name is Josh Enomoto, and welcome to InvestorThread.com. Now, you'll notice on my website that there are several articles involving advanced multi-leg options strategies, and they can be very powerful weapons in your arsenal. But if you don't know the basics of options, it's going to be very complicated. So, what I'd like to do is to just get into the basics of what a call option is, and then we can build the foundations to get into these multi-leg strategies. And as you'll find as we go on this journey together, you'll find that option strategies, multi-leg option strategies such as the vertical spread or the condor, even though they sound very complicated, you'll understand that once you get the basic foundational blocks, you'll realize that they're remarkably easy to understand, and you'll be very excited to utilize these strategies into your everyday trading, because it really opens up the full spectrum of options, no pun intended. So let's begin with the call option. Now, I recommend, of course, that this is not going to be a holistic explanation of options, which are also known as derivatives or derivative contracts. So I recommend that you use this sort of as a quick step guide into learning about options trading. But you'll want to to have a full understanding. You'll want to consult educational material, of which there is so much out there. You can buy books, you can go to classes. There are a lot of free resources available. So I'm just going to dive into a simple explanation to kind of get everybody up to speed. So a call option is basically a contract. It gives the holder, the buyer of the call option, the right, but not the obligation to buy the underlying security at a specified strike price. And the privilege of owning that contract comes at a cost. That cost is called the premium, okay? Now, as an option buyer, as a call option buyer, you have to pay the premium. Every option, though, has two transactions. There is the buyer, and then there is a seller, or the writer of the option. And in the case of calls, there is a call writer or call seller. And the call writer or call seller receives the premium that the buyer is paying. That the call seller is receiving the premium because essentially he or she is underwriting the risk that the call will not be able to be exercised, meaning that the underlying security will go down instead of going up. Because remember, a call option gives you the right to buy a security at a specified strike price. So you want the stock to go higher and higher and higher, and have a contract that allows you to buy that super expensive stock at a lower strike price. That's what makes a call option profitable. But in order to secure that contract, of course, you have to pay that premium. The other person, the seller, is taking the opposite side of the bet and is receiving income from that from receiving that premium, hoping that the stock does not go up. And if the stock does not go up, the call seller wins. But if the stock does go up, the call seller obviously loses. Okay, because then at that point, if the call becomes profitable, the buyer will likely exercise that contract and has a contract to buy the underlying security at a lower strike price, and the call seller is legally obligated to fulfill that contract. And that's the one reason why you never want to sell so-called uncovered calls. Because if you sell an uncovered call and the stock does go up, you are liable for assignment, meaning that the other party, the buyer, is going to exercise those calls, and you would have to cough up the shares. If you don't have the shares, that's going to be a big problem. It's going to be very expensive, and that's because stocks can go up and up and up to infinity, theoretically speaking. The call seller, if it's an uncovered call position, is subject potentially to, theoretically, to unlimited liability. Now, it doesn't really get into that to that point. There will be a margin call prior to that situation actually materializing, but I just want to again warn you straight up about the risk of writing uncovered or selling uncovered calls. So a lot of this sounds like BS. So let's do a diagram. I'm a visual learner. A lot of people, I think most people are visual learners. So let's learn about call options visually. Okay. So I'm going to draw a profit loss diagram. This line will represent the break-even point. So above the break-even point, you're profitable. Below the break-even point, you are not profitable. You're losing. Okay, so far, very simple. Let's assume that right now you're interested in buying XYZ stock. And let's assume that this stock is priced at $100. Let's also assume that you want to buy a call option at $100 or with a strike price of $100. Now, of course, you can't just buy a call option at $100 with a $100 strike price. You have to, pay a premium, like we talked about, for that privilege. So let's just say, just using real easy examples, the premium is $10. Okay, so you add $10, the premium, to the strike price $100. You get 110. 110 is your break-even point. That means that even though you have the security itself, the stock itself may be at $100, and you bought a call option at $100, meaning that this call option is at the money, or abbreviated ATM, you're still not profitable on that trade, or you're not breaking even on that trade because you paid a $10 premium. You add the premium to your strike price to get to your break even point, meaning that the stock, XYZ stock, has to go up to $110 for you personally as a call buyer to break even. So as of right now, you are not only not breaking even, but you're at a negative. You're losing money. Okay, and of course, at $100 or less than $100, you'll be losing money. So whether it goes to $50 or $0, you're losing money. However, let's just say the XYZ, there was some positive catalyst, they released positive earnings or whatever the case may be, and it started moving higher in the market. As it moves higher to your break-even point, to 110, your position becomes less and less negative. Now, if the stock goes beyond your break even point. Let's say it goes to 111 or whatever, then beyond 110, beyond your break even point, your call option becomes profitable. And the higher and higher the underlying stock goes, the more and more profit you enjoy. Theoretically speaking, a stock price has no upside limit. So while I mentioned that there is a risk of the call seller absorbing unlimited losses, you as a call buyer may have unlimited gains. If this thing keeps going up and up and up to infinity prior to the expiration date, you're going to be very, very profitable. And that's why options, there's a lot more to this, but options can make you rich. I mean, if you, let's say you bought a far out the money call option and the stock does eventually go to that point, you can be very, very wealthy. But as you can see, this is also a directional wager, because if the stock doesn't go beyond your break even point, and let's say it hits 105 or like 109 or whatever, right? There will be no point in exercising the entire principal that you put into buying the $100 call option. Is, to you, it's worthless because you paid a premium of 110, right? You paid a $10 premium, bringing the break even price to 110. So if the stock only goes up to 109, still worthless. And so it becomes an all or nothing type of wager that can be very, very risky. And a lot of people don't like that risk. Of course, you might say, hey, why don't I just buy a call option at $90 or with a strike price of $90 or $80? And at that point, I would just straight up be profitable by buying a call option that is deep in the money, as we call it, or ITM, deep ITM. Yeah, you can do that. However, the market isn't stupid, okay? Because if you buy a deep ITM, let's say you buy a $50 call option and the underlying stock is in the open market, in the regular market, not the options market, in the regular market is at $100, okay, and you bought a call option with a strike of $50, sure, technically that contract by itself is deep in the money, deeply profitable, but you personally will pay an exorbitant premium. You're going to pay a lot of premium. So yeah, you can buy a very deep ITM call option, but guaranteed your premium is going to be way up here, so that the stock price needs to go very high in order for you just to break even. So the market isn't stupid like that. It doesn't give you that kind of free arbitrage situation. No, 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 no. The options market is not stupid, okay? It is a very rational place. I mean, 99% of the time, it's a very rational place. You may find unusual nuances, briefly speaking, where you might be able to exploit certain arbitrage situations. But again, 99% of the time, the options market is very rational. Yes, you can buy a deep ITM call option, but you will be paying through the nose. Conversely, you may not like paying such a high premium, and you can buy so-called cheap call options by buying a call option that's out the money. OTM, deep OTM, or far OTM call options. Those are very cheap. Those have a very cheap premium, and you might be tempted to buy those super cheap, call options with premiums that are only like 5 cents or whatever. But be warned, again, the options market is a very rational place. You buy very cheap options, you're going to pay for it, because the reason why a cheap option is so cheap is because it's unlikely that the call option will be profitable. It's very unlikely that it will even break even. Okay, and so that's the understanding of it. Yes, you can buy these call options, and they can be very powerful just by itself, right? Just by itself, buy a call option. If the stock goes in your favor, um, it's wonderful. But it's also a directional wager. If the stock does not go in your favor and enough of a magnitude in your favor, you will likely lose the entire premium that you paid for that call option. And so there are ways of protecting that premium, or playing around with the probabilities of making money or generating income, right? By controlling risk. And that's where you buy multiple call options, or you buy one, you sell another. This is where you start building more complex option strategies. And while they might sound complex, they can be very, very powerful tools. But first, we got to get to the basics. And this is really the basics of the call option. Gives you the right to buy the underlying security at a specific strike price, but you pay a premium for the privilege. Conversely, on the other side of the equation, there is a call writer, a call seller, and that person receives income, but that person is also underwriting the risk that the stock will not go higher and is taking a bet against you. Okay, so there are two components here that you have to remember. When you buy a call, you're speculating that the stock will go up. When you sell a call, you're generating income and underwriting the risk that the stock will not go up. Okay, and that instead it'll go flat or go down. So those are the two basic mechanisms of what's going on with a call option. In the next video, we will discuss the intricacies of the put option.